that you said, what's up? Dear Beard, no way. He don't know. Do you know him? He doesn't know me probably, but yeah, at Oregon, I got to hit him a couple times. And then for the Ravens, where else was he? He ended up somewhere else too. I'm not positive, but he was a wall. He was definitely hitting a wall. All right. So let's get USC went down. Yeah, they did. I'll tell hello to you. Said what's up? Yeah, Trojans, and that's not good for the Pac-12. But let's be real. I didn't think they were that. They scrimped through about 3 or 4 games. They beat the Cougs bad, but the Cougs had about 18 dudes out. So we had, I think, 3 returning starters on defense, a bunch of freshmen. So Jacob Jenkins. I don't know where your head's at on the Trojans, but I am not mad that they lost. It is hard to see the Ducks get it. Like, and this is the question: is like, did I want the Huskies to win it? No. Did I want the Ducks to win it? No. So I don't know. But let's stay on topic today because I think today's going to be a good one. Let's get the old measurement out because this is a question we get a lot. And what we want to know today is what is the difference between stocks and bonds? How are they differently made up? Go Ducks. Tara Fritz. All right. Yeah, I'll give you a go Ducks. I mean, hey, they champs. I don't know if I want to call them that, but they are. So we got to recognize that. We got to respect it. So we're going to go hot session today, stocks, bonds, and we're going to talk about mutual funds and index funds, what the difference are there. So let's look at this real quick. Let me get, how am I going to get, there you go. Boom. So one thing I always love to address is this idea of what these are also called. So equity and debt. So I like to identify these names because people, you're at a cocktail party and somebody's, blah, 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 I bought equity in this company. Blah, blah. That means they bought stock. That means they bought ownership. Why does that matter? We're going to talk about that here in a second because a bond is simply debt. So these are also known as. So you can also call a stock equity. You can also call bond debt. And this makes you a partner. This makes you a lender. So because of those relationships, because you're starting to see money for what it is, if I give out a bond, I'm giving money and I am a lender. They owe me money. If I buy a stock, I am no longer a lender. I am a partner. I own part of the company. Danny Ayer, welcome in. Afternoon, Danny. What's good? So as we look at this identification, equity makes me a partner. Debt makes me a lender. Debt meaning I want my money back eventually. So you got to understand why people are looking at this, why people are looking at that. This is the understanding that we have to do because if you look at risk as the measurement, the risk measurement for bonds is going to be lower, for stocks is going to be higher. And what we learned a few days ago as we looked through the principles around money, we started to understand do, re, mi, re, risk equals return. Debt covenants can limit equity. Thoughts on growth versus value. I love it, Iku. Not what I expected to find on my FYP, but I'm here for it. Sarah Anderson, welcome in. This is what we're talking about. Financial. I'm a CFP, former NFL player, so we talk a little sports, but today we're focusing on stocks, bonds, mutual funds, and index funds. What are the difference between those two? That's really what the objective of today is. And Sarah, if you stick around, there's a question at the end that you can win $50. Did he say 50? He did say $50. Or you can get a course or a book. Just wanted to say thanks for putting these on and helping to educate us. Matthew 70. Respect, Matthew. Thank you for coming in. I'm in private equity and do debt. LE Bulldozer. So as we look at these, the risk profile. So why I want to have bonds is because if I need money in the next year or 2 years, I want to put those in bonds because the risk is lower. Stocks are longer term going to be higher risk with a higher return over that time period. I want 500. All right, Bulldozer's going to get 500. So as we look at these, now you start to see the relationships of them. So here's the interesting factor. So if I gave somebody, two friends went and started businesses. One got a $5 bond. One sold $5 of stock. So the bond, let's go by week by week. 1, 2, 3. They got $5, right? So after week 1, nobody made any money. First week of business is hard to make money, so they went out, made $0. After week 1, if I took on that debt, I still owe $1. See that? Now, if I was in the stock, I would not owe anybody anything because I don't have debt, I have partners. That's a significant difference. Now, let's say the next week we started to crush it. I got $4. Went out, I made $4. Well, this bondholder over here says, well, I made $4. I just have to pay my $1 of stock back or my $1 of debt back. That is the interest. We learned about that a few chapters ago. When I borrow somebody else's money in that lend-or-lendee relationship, somebody is going to charge interest. Whether it's your bank, your uncle, or a company, they're always going to charge interest. I made $4 this week in my company, but I now have to give 2 of those dollars to my partner. We share in the ups and the downs. $4, I'm splitting it $2 to $2. And then let's say I lost money. Let's say it's a bummer. I lost $2 the next week. So this first week we made 0, then we made 4. Now we're minus 2. If I lose $2, this person over here, they not only lost the $2, but they also have to pay that person back the $1. So that's going to end up being a $3 payment. This person over here lost $2, but the good news is they only lose 1 because they're splitting it now with their partner, with that equity holder. So you got to understand. Go Cougs, Jason Miller. I'm watching the game. I got it paused. So far, looking good. Bonds are locked in, correct? So when you say bonds are locked in, so bond has 2 measurements. It has a term and a rate. So let's get rid of this. So we see that now when somebody says I bought equity, you realize that just means they bought stock and they are part owners. When they say debt, I raised debt, that means they took on a bond. So for a bond, it could be 1 month, 1 year, 10 years. See that? And then who is issuing it? So it could be the government, could be a city, or it could be a company. Who is issuing it? And then what is the percentage? And the percentage is always going to be based off of how long and who. If this person, if this company is riskier, you need to give me more percentage. You need to give me a higher percentage to borrow my money. Why are credit cards so expensive is because they rent to or loan out to individuals who you don't know if they're going to pay you back or not, so they charge more money. So this is the idea or measurement around bonds. So the difference between a stock and a bond is what kind of relationship are you buying into? Are you a lender or are you a partner? And when people look at equities, when people look at the equity market, which is the stock market as we all know and love, you start to look at that and say, well, I as a young person, I see the lower risk in bonds. I see how that can be taken off my plate, but I really want a longer term return. I want a higher return over a long-term time period. So that's why young people venture towards the stock market. It is higher returns, but it is also higher risk. Older people or people who want to protect money, that's why they enter into the bond market. It's also diversification. As we know on here, you should not be all in one thing, not one asset class. Welcome in, Adam House. We got some questions. I got to get to your questions tomorrow or Monday. Love your questions. Go Cougs. And so bonds lock in on the interest rate, but they always set the interest rate on the face value. So if it's a $1,000 bond, right, this is the face value at, let's call it 3%. You can call it coupon, whatever you want to call it. So that is always going to be related. So that $30 on that bond. Now, what does change is not this part, but this can change based on where the market is going. This is a confusing piece, and you don't really need to know all of this. But oddly enough, as interest rates go up, bond prices go down. That is inversely correlated. We're not going to dive into all of this right now. Because like I said, we're going hot money today, stocks, bonds. So how do you go about buying stocks and bonds? How do you go about purchasing them? Well, that is a concept I love to share. So this is going to be related to the question of the day. Okay, thanks, man. WC5337, you're welcome. Hey, we answered a question. I like it. This is what we do. All right, so this is where you need to understand. So I now look at it and I say, hey, for me, younger person, I have my portfolio. So I might have a few bonds. I might have some protection. I call it capital preservation. It's there to preserve the capital. But as I look at growing, Mustang, you're about to see Mustang, CU, and Freddie. You're about to see how you can go about buying stocks. This is an important designation. So if I wanted to go buy company, let's call it company X. Company X. I want to go buy company X. That's a single company. I want to buy one company. You fill in the company that it is. Right now, everybody wants to talk about Tesla, Amazon, Spotify, Shopify, any of those. That's company X. You can go buy a single company at a time. Or you can say, well, I don't want to just buy company X. What if I wanted to buy company X, Y, Z, and W? I want to buy company W, X, Y, and Z. That's a different offering. I want to buy a grouping of companies. I don't want to just buy a single company because that is really hard to predict and guess who and what is going to be profitable. But then somebody comes around, let's say MME 467 comes in and says, well, listen, I don't want to just buy one company. I see a couple companies, but let's be real. If I buy 5 tech companies or if I buy 5 health industry companies, they're all still related. And what I learned from Suman Ninja, I learned from the ninja the other day that diversification means one event cannot disrupt them all. One event can still disrupt all these. It is more diversified than buying one company, but I want to add in this diversification here. So that is where we're starting to build. So I don't want just company X. I see this risk and I see the return. I diversify it a little. And then you ask the question, well, hey, what if I wanted to buy companies A through Z? I don't want to just buy X. I don't want to buy a group of them. I want to buy the whole alphabet. How can I buy that whole alphabet? This is what is so cool and so powerful about the world and day to day. This is a single company. This is a mutual fund or ETF, and I'll explain that here in a second. You can't even read that. I'm going to rewrite that. Mutual fund / ETF. And this is the index we all hear about. So as you look at those, this is the designation of what you want to buy. This is the beginning of how you start to invest. You look at it and you say, okay, if I want risk, I'm going to buy a single company. Why? Because that company can skyrocket. I don't have to pay anybody. This company says I can go from 0 to 100 real quick, but I can also go from 100 to 0. This says, all right, now I want a group of them. I have to pay somebody, an advisor or a mutual fund manager, to actually go and select what's going to be in the fund. That is going to be a fee. And that is something that we all have to be able to understand is if I start to have something in a group, I have to pay somebody to do that. Then we get to this index fund. And this index fund says it's not a grouping anymore. Now you're buying the whole class. Troy, welcome in, Troy. We're talking about index funds and how to begin to invest. So as I look at this, I see this and say, hey, I don't want to just go buy, 5 to 10 to 20 companies. I want to buy hundreds or thousands of companies with a single purchase, with a single decision. That is the power. Chad Montgomery has this power that they are allowed to do. So do you recommend an ETF mutual fund or small portions of a bunch of different unrelated ones? That's a great question. All right, WC, here's the answer. And this is because I'm a certified financial planner. I am not a broker. I don't trade. I don't do any of those things. I know the market and I know the research and I know the history. So the history says from active investing, you actually decrease your odds of outperforming a passive single decision the more managers you have. Let me repeat that. If I pick a single ETF that is broadly diversified, I will decrease my odds of success adding more mutual funds and ETFs. Why? Because it is so difficult, it is so rare for people to actually beat the market. And we've talked about this the last few days as investment has been the topic. It is so uncommon for one person to beat the market that you adding more people, more strategies, more decisions is going to decrease your odds of outperforming. So personally, I believe in trying to have as few options as possible. Can I set up an entire portfolio with 1, 2, 3, 4 decisions? Can I do it with one decision? Yes, you can. So I would recommend having your secure, your singles index funds, your doubles ETFs or mutual funds, and then going for home runs with some of your singles or some of your individual purchases. Chael 023, welcome in. So do ETFs and index funds include stocks and bonds or just stocks? So you can get a mutual fund or you can get an index fund of bonds. So yes, you can buy bonds the same way you buy stocks. And so the difference between a mutual fund and an index fund is a little bit of how they're traded. ETFs trade like a stock. Mutual funds wait until the end of the day to actually get their fair pricing. So ETFs are valued based like a stock price. It goes up and goes down with Mutual funds actually look at the value of the underlying assets. So the companies that are there, and they actually have it's called a net asset value that is a little bit closer to what the reality is. You'll see big institutional investors stick with mutual funds because they are a little more true to the pricing. ETFs, just like buying a stock, it's going to be cheaper, but it's not going to be as precise. From a tax perspective, same thought. Mutual funds have a little bit more stipulations. ETFs going to be handled more like the stock from a tax perspective. So almost like the phrase, too many cooks in the kitchen. WC, that's exactly the phrase. That's an excellent phrase. So yes, when you look at your portfolio, if you have 9 different managers in there with 9 different strategies, 9 different thoughts, your odds are going to go down because they're going to begin to destruct each other. They're going to counterintuitive, and you can see it as diversification, but that's only if they're truly inversely related and really protecting you from the down. Good questions, though. Love this. This is a little more money. So Mike Burke coming in saying you can index commodities as well, including gold. And here's what I'm going to tell you. When Bitcoin or cryptocurrency really wants to, and I believe they already have some mutual fund ETFs of cryptocurrencies, you can do it with that commodity as well. But yes, gold, silver, gas, oil, but all of those types of things will have mutual funds and have a grouping, so you don't have to have single individual investments into them because people are realizing it's very hard to guess right on an individual. So tangent question, what is your thought on Notre Dame possibly boycotting the playoffs? Zane, very tangential question. You just saw this morning a bunch of teams are announcing they're not going to go to bowl games. Surprising. Notre Dame doesn't need the money. A lot of teams do need the money. I don't know. It is at a point where, the vaccine's out. I see a light at the end of the tunnel, and it's like, what is one more game going to really do? But it is, as a young person, as a young athlete, I want to play. So that's really, really hard. Health risks got to weigh in. So as you look at this is how we're going to begin to build out our portfolio. Now, how would you go about doing that? Well, let me introduce you to a few few index funds. S&P 500, Russell 3000. Yeah, let's call it VT. So if you say, hey, Jed, how do I go and actually buy and begin to build a portfolio? I know I'm not going to be a day trader. I know I'm not going to try to hit a home run overnight. So you look at the S&P 500, which Warren Buffett has said could possibly be one of the best and easiest investments for any young investor. Why? Because it takes the top 500 companies in the United States. And not only that, it filters them. Each year, each quarter, they reevaluate who is supposed to be in that top 500. This year alone has seen the top 5 companies, which you would know, Apple, Microsoft, Amazon, soon to be Tesla, have really pulled up the S&P 500. But this is the top 500 companies in the United States with one purchase, and you can buy them at anywhere. Acorns, Robinhood, Betterment, TD Ameritrade, Fidelity, Schwab, list them. Everyone offers an S&P 500 index. I almost guarantee it, and I don't like using that word guarantee around money. But this S&P 500 is going to be a foundational piece of your portfolio. Then you look at something like the Russell 3000 and you say 500 of the top companies. Well, aren't they all large cap? So that is measured. So Russell 3000. The Russell 3000 is the 3,000 largest companies. So there's some small, there's some mid, and there's some large in there. With a single purchase, you can buy the entire index of 3,000 companies. That is diversification. That is a real need. I heard Tesla just got into the S&P. $80 billion were pumped into Tesla stock. Can you explain this process? So yes, you have to have sequential quarters of positive returns. You also have to have a cap rate, which is just how many stocks are issued multiplied by how much they cost. You have to have a cap rate that would warrant being in the top 500. So Tesla has been fighting to get in, and they've been on a crazy roller coaster of a company's returns, and they have finally met all the standards to enter into the S&P 500. Why their stock is going crazy at the moment is because entering into the S&P 500 means every hedge fund, every retirement fund, every person in America who buys the S&P 500 has to buy the Tesla now. Whether they want to or not, it's going to be in the S&P 500. They are buying into it. So now even the people who are like, I don't trust Elon Musk, I don't know, he's kind of crazy. As crazy as he is, he now gets the green light. He gets a pass. What index fund would you suggest to diversify my portfolio for the long run? Great question, Marinello. This is the one I always love to say start with. Why? Global, low fees. Why I love Vanguard's World Index. Again, it's thousands of companies with a single choice. And if I was going to be 16, 20, 25 and just say, hey, I don't know the market that well, but I want to start dipping my fingers into it. LeBron's leg cramps. The S&P is long-term investment. Absolutely. The S&P 500 is simply betting on America. Do you believe America's economy will be strong in 10, 20, 30 years? If you do, you want the top 500 companies in our country. The S&P 500 is how to do that. So are they kicked out if they have consecutive quarters of profit of loss? Yes, not directly, but if they fall, so ConocoPhillips, the gas and oil company, was number one in 2011 or 2012. ConocoPhillips just got removed from the S&P 500. So if you start to lower your cap rate, the measurement and value of your company, this is why the S&P 500 index is so cool, is it washes them out. Get the losers out, bring in some of the new winners. That filtration system is really advantageous to young investors like yourself. So yes, I think the S&P 500, and it's not my brainiac idea, I'd steal from people like Warren Buffett who say the S&P 500 is going to be a great index over that long term, especially if you want to tilt to America. So why I say VT is really interesting is because it is globally diversified. Vanguard is the parent of lowering fees and looking at costs and being able to say it that way. If I had to buy just one, that's where I would start. Then if you were to say, well, Jed, I love America. Well, good. Okay, so maybe this is 50% of your portfolio. Then the S&P 500 is 25%. Okay? With two purchases, I am not only globally diversified, I am lowering fees, I have a tilt to America, and now I can take this last quarter and you get to play. Guess. Figure out what is going to boost. Where is your home run? This is a single. This is a double. This is your question. This is what you want to go get. Do you want that home run? LeBron legs cramp. Yes, it won't really go up above 10% annually, but also won't lose very much. Yeah, so there you go. I have Vanguard. It was my first investment. Ursher, my first investment was Vanguard. It's a proven company. It's low fees. They have good strategies, and it's a great introduction. When we go through and we're finishing up chapter 6 of Money Vehicle today, this is, a WC. Absolutely. Great comment. So keep that conversation going between Ursher and WC. I love that. By the way, my Buckeyes pulled it out. All right. I got to get back to my Cougs here in about 4 minutes. So that's why we're jumping on fast today. All finance today on a Cougar football Saturday. Kind of counterintuitive, but wanted to really introduce you to these thoughts. So as you look at the risk tree, you see risk low or high, low. See that? High, low. We're going to go single mutual fund index. And this is what I want people to understand. Bam. This is simple, but this is understanding money. Why the market is no longer going to intimidate or overwhelm you anymore is because you understand these concepts. Now, somebody asked earlier, and this will be the last question, then we're going to get a winner and get out of here because everybody wants to get back to some college football. The difference between a growth stock and a value stock. So is this based off a book or is this just sharing knowledge? WC, Money Vehicle has a book, Your Money Vehicle. We also have one of the first online virtual certification courses at yourmoneyvehicle.com. It's in my bio. Go to check it out. I would love your thoughts, feedback. And honestly, we're giving the course away because, guys, we're getting contracts for schools and colleges and clubs. If you have a club or a group of teenagers or young 20-year-olds who are like, hey, why don't we get together and learn about money? This is going to be a great resource for you. I remember playing with you and Madden, and now you're teaching me about stocks. Keep up the work, brother. Also, 12356. That's awesome. Made my day. Very cool. Okay, so the difference between growth and value. So speaking of playing in the NFL, this is how I would look at it. Okay, Drew Brees, right? Drew Brees got injured, hurt his shoulder, leaving San Diego. The Saints and everybody else in the NFL knew Drew Brees as a product. They knew what he was capable of. But with the injury, he wasn't getting the value that people thought he maybe deserved or could. So teams came in and said, hey, listen, because of your injury, we're going to offer you this price. We're going to get a good product at a good price. That is value. The growth side of that is a team looking at the kid coming out of college and saying, we don't really know what he has yet, but we see his future going like this. We see his future skyrocketing. So that is a growth stock. So when you look at companies, you say, I believe I know Coca-Cola, or let's use the airlines right now. I know the airlines. I know this event has destroyed their stock, but I know what they do and what they are. And I think I can get a good company at a really good price. That is a value purchase. The growth side of that is, well, I think technology, or I think the world is going to start to use different forms of transportation, electric hybrid cars. They are skyrocketing right now, but before they really take off, I'm going to get in on them. That is the growth. And so as you look at how you are going to get paid back, you are betting that this company is going to return to its value. This company is going to exponentially take off. Great analogy, Danny Iyer. That's what we do. Storytelling is key. What we want to do different about money is teach people money through stories. That's it. If I can get you to understand an analogy, and there's in Money Vehicle, every chapter has new analogies because they're way better. I don't want to be a stale old dude talking about money the same way people have for 30 years. It doesn't work. So we tell stories to teach money. That's what Money Vehicle is doing. That's why we're scaling and growing, is because students go through the course and go, man, Jed, you're a little corny at times, because if you ever want to see my acting skills, you got to go through the virtual course. There's a professional wrestler. There's a Cajun mechanic. There is a nerd. There is a ton of different people. You got to go check them out. I love your responses. So the question of the day, let's get some winners. And I love that we're getting some people coming in, people going out. So the questions of the day. Number one, debt and equity, or tell me what debt and equity are also called. What is the two terms that we're telling you today? And then tell me why an index fund is an advantage for young investors. So debt and equity are related to what investment, and why are index funds an advantage? Telling stories is one of the best teaching strategies. John Kim, I cannot tell people that enough. First off, you got a journal, but as you start to write, you will begin to learn how to speak, and it will change your game, change your world. So lender and lendee, diversification, love it. Ursher, stock equals equity, bonds equals it. Index groups many companies together. Ursher coming in hot. John Kim, stock and bond coming in hot. WC, welcome in. WC 5337, debt bond. So let me get this. WC 5337. So I think we got Ursher coming in with the win. Danny Ayer. No, maybe Danny. I didn't see Danny. Sorry, Danny. Danny _ Ayer. My man John Kim, love it. John's going through the book, going through the course, and learning everything. Sarah stuck around. I like it, Sarah. All right. You gonna Sarah Anderson, 35. I love it. Decodu's bonds, index funds are more diversified. Index funds good for young people, low risk, long time growth. WC, I love it. You know, I just want a book. The book is coming, Ursher. It's coming. We got to wait. COVID, all the mailbox, all the UPS, everybody's overwhelmed with holidays. So we're waiting until January, but the signed books are coming out. I appreciate you all, respect you all. Tomorrow we will be going back to the original time, 7 Eastern, 4 Pacific, and then we're gonna start. I mean, tomorrow, 10 days left. We're almost there. LeBron's leg cramp. Oh, LeBron, I ain't got you yet. All right, I gotta get your email down, Julian dot, because we wanted to talk about getting it on campus. Love. All right, when are your lives usually? I learned a lot, man. Hey, also, 12. That's what we're here, man. We're here to teach. We're here to learn. Tomorrow we will be going at 7, 4 o'clock Pacific. And we got, live every day of December teaching different parts of money. Check your DM. I sent you that email. Ursher. Love it. Ursher spreading the word. LeBron's leg cramp starting to spread the word. Also, welcome back. We got a collab. We will. I got you. I'll email you today or probably tomorrow. 6 Central. I like it. Vitamin Dugan. Keep me right. Somebody got to keep me in check. All right. You all make it worthwhile. Enjoy the day. Go Cougs. See y'all tomorrow. Peace.